Let's take a look at the markets now. Asian markets fell sharply today following the lead of the United States, where stocks also took a dive. Uncertainty prevailed as market players assessed the Fed's latest rate hike. The Japanese Nikkei share average ended 0.7% in the red. The Hong Kong Hang Seng Index also declined quite sharply, with that declining by 2%, over 2%. The Shanghai Composite Index falling by 3.81%. Mainland China is having to contend with the authorities' zero-tolerance approach to COVID-19 cases. That saw the Shanghai Composite Index decline by 2.16%, and just as a point of correction, the Hang Seng Index declined by 3.81%. Over in the United States, stocks ended sharply lower yesterday as investor sentiment cratered in the face of concerns that the Federal Reserve's interest rate hike would not be enough to tame surging inflation. All three main Wall Street benchmarks erased gains made during a relief rally on Wednesday. Market analysts said players were in the grips of fear as they were unsure where to put their money. The Dow Jones Industrial Average fell by 3.12%. The S&P 500 lost 3.5%, while the Nasdaq Composite was the hardest hit, plunging by 4.99%. Let's just call that down by 5%. Let's take a quick look at the indicators. All right, to take us through the markets, I'm joined by Warwick Lucas. He's the head of Galileo Securities. Thanks very much for joining us, Warwick. So today's markets are in serious turmoil, our local ones too. I guess this is all to do with the Fed's 50 basis point interest rate increase.
Very much so. I mean, it certainly would seem strange that markets should belatedly be surprised about an interest rate hike. I mean, after all, these rate hikes were really very well telegraphed. I mean, we know that US inflation has been running hard. The Fed has been talking about quantitative tightening and raising interest rates, and yet here we are. And I think that part of the issue is that the market is finally dealing with the idea that there's first of all going to be a series of interest rate hikes, and that there's always a risk of policy error when you're managing those series of hikes, that maybe they can overdo it in the whole process. So the Fed's allowed itself to get behind the curve rather badly, and now there's a lot of catching up to do. And that process of trying to deal with uncertainty, with not being sure how the series of hikes is going to pan out, is, I think, getting priced in.
Yeah, I think you explained that well, because, of course, the market did believe that the Fed was actually behind the curve in terms of when it decided to start raising rates. But what does this mean for emerging markets like South Africa? Does this then mean that the Reserve Bank will also have to raise interest rates by 50 basis points later this month?
Okay, so to some extent, a stronger dollar already acts as a kind of a rate hike for emerging markets already. However, in the case of South Africa, we're not really enjoying the same kind of growth or the low unemployment that the US is. So nevertheless, we will have the problem of imported inflation because, you know, we're not sure whether we'll hike aggressively as the US. I mean, our economy isn't strong. It's got supply side constraints like the power grid. But nevertheless, we do have some inflation that's coming in, and it could potentially be sticky. So to some degree, we'll get sucked along, hopefully not as hard.
One constraint for our economy is obviously higher oil prices. But what does the EU ban on Russian oil in the next 6 months mean for oil prices? Does it mean that they should actually be depressed because you're suddenly not going to have all of this supply, and maybe Russia will actually struggle to find an alternative place to send that oil? Should that actually depress prices or heighten them?
Okay, so I think it's potentially quite a messy answer to that question. I mean, there isn't really one single oil price per se. I mean, the grade of the oil and where it's delivered often matters very much. So you get lots of different oil prices. The quote that we most commonly see, of course, is the Brent oil price, which is the most purchased grade in Europe. And inevitably, that's the one that's going to respond most to sanctions because, of course, it's delivered in Europe. And it's along with other grades, it's going to have to replace Russian oil, which will, as you correctly point out, have to get sold somewhere else. All that production from Russia, of course, comes off the market, and that overall then does indeed push oil prices up.
Of course, next week is the mining Indaba, the Africa Mining Indaba, which kicks off on Monday. We know that the mining sector has really proven quite a boon for the South African economy, especially the fiscus, as it's helped to lift up our coffers because of the commodity boom. What is it that you're expecting to come out of that? Of course, we've just had President Ramaphosa raging and raving about Anglo-American introducing this new hydrogen-powered truck that will haul around, all of the products that it gets from, from underground, which is a positive move. And I suppose these are some of the conversations that are going to be had going forward about how do we mine in a sustainable manner and reduce our carbon footprint.
All right, so looking holistically, I mean, given the terrible impact that both COVID and COVID preventative measures inflicted on the economy, I mean, it was almost a life and death case for mining to come through for South Africa, and indeed fortuitous that it did. But notwithstanding the importance of mining to our economy, our country's competitiveness, as rated by the likes of the Fraser Institute, has seen us fall from position 40 in 2019 to number 75 in 2021. Only 3 years, and that's out of 84 countries. Now, the key issues are things like power availability, logistics problems, our policy framework, possibly cost of capital. But all in all, what that means is that despite the importance of the sector to our country, we're not looking after it properly, we're not encouraging it, we're not growing it, and we urgently need to do the reforms that would, by the by, see that ranking improved. And that's really what I'm looking for.
Thank you very much, Warwick, for your insights there. As always, Warwick Lucas, he's the head of Galileo Securities.